Hello, property navigators. Australia's housing market presents a paradox. Amidst reports of a dire undersupply of housing across the country, certain markets have witnessed a reduction or stagnation in house values. How the hell could this be? Well, today, drawing upon insights from Eliza Owen, the head of research at CoreLogic, I'll explore the layers beneath these market dynamics. I'll begin our video with a stark projection by Housing Australia, forecasting a shortfall exceeding 100,000 dwellings by the end of 2028. This alarming figure forms the cornerstone of government policy, yet does not align with the observed drop in value in some housing markets. Melbourne, a city renowned for its vibrant culture and economic opportunities, stands as a prime example. Here, home values have seen a decline of 0.9% over 3 months to January 2024, amidst increasing listings. In fact, in the year to November 2023, 81,000 properties were purchased, but over 90,000 properties were listed for sale. So there is an oversupply in that sense, which contradicts the broader narrative of housing scarcity around the country. I'm sure you've all heard the headlines talking about Australia's housing shortage. To understand these issues properly, we need to recognise and distinguish two separate issues here in Australia. One, the demand for purchasable housing, and two, the essential need for accommodation. Now let's start by explaining both of these, kicking off firstly with the demand for purchasable housing. Now the demand for investors and home buyers to purchase housing comes back to consumer and human psychology. There's a myriad of reasons that affect what's known as the sentiment of those wishing to buy. Investor sentiment in the property investment space is a complex interplay of psychology, economic and sociable factors that influence an investor's decision to buy, hold or sell real estate. It's kind of like a barometer of an investor's confidence in the property market, shaped by their perceptions of potential risk and reward. Understanding the factors that affect investor sentiment is crucial for navigating the real estate investment landscape. Here are some key elements that play a pivotal role in property investor sentiment. Economic indicators such as interest rates. Now, low interest rates make borrowing cheaper, encouraging investors to finance property purchases, as we have just saw when interest rates were super low. Conversely, high interest rates can dampen investment enthusiasm due to higher borrowing costs. Economic growth. Strong economic performance boosts investor confidence, as it often leads to higher employment, income levels, and demand for property. Inflation. Moderate inflation can indicate a healthy economy, potentially leading to property value appreciation. However, high inflation may erode real returns on investment. Market dynamics such as supply and demand. An undersupply of properties in a high demand area can lead to capital appreciation, and as we have seen in recent years, it is attracting to investors. Oversupply, however, can depress prices and deter investment. Rental yields. High rental yields indicate a strong rental market, enhancing the appeal of investment properties as income-generating assets. Property values. Rising property values can create a positive feedback loop, attracting more investors hoping for capital gains. Declining values can signal a market downturn, impacting sentiment negatively. Government policies and regulations. Taxation. Tax incentives for property investors, such as deductions on mortgage interest, can enhance the attractiveness of real estate investment. Conversely, high property taxes or changes in tax policy, such as land tax changes, can detract from it. Zoning and development regulations. Regulations that facilitate property development can increase the supply of investable properties, while restrictive policies can limit this supply. Housing policies. Government interventions in the housing market, such as subsidies for first-time home buyers or rent controls, can impact investor returns and in turn impact investor sentiment. And global events, geopolitical events. Political instability, trade wars, and international conflicts can lead to economic uncertainty, influencing global investment patterns and sentiment towards local property markets. Pandemics and natural disasters. Events like COVID-19 and other pandemics can drastically alter investor sentiment, affecting property demand differently across sectors, for example, residential versus commercial. So as you can see, investor sentiment in the property investment space is dynamic and influenced by a myriad of factors. Navigating this landscape requires a keen understanding of both the micro and macroeconomic indicators, government policies, social trends, and global events that can sway investment decisions. And think about it by putting yourself in the shoes of the investor. Would you spend $600,000, $700,000, $800,000 or more on an investment property if you weren't completely confident in some of the above points, knowing that if you were to be wrong, you could cost yourself hundreds of thousands of dollars, maybe even more, by making the wrong choice? Just a little bit of food for thought. So in this bucket, we have basically all the reasons why property buyers may or may not want to purchase a property right now, being the operative words. Now let's move on to explaining the second aspect here, the essential need for accommodation. Now this is a more fundamental need, mostly unaffected by those variables I spoke about when explaining investor sentiment. Let's again revisit the example of Melbourne. Now, despite the recent declining purchase values, which should generally indicate an oversupply, the demand for living spaces as evidenced by rental market dynamics tells a starkly different story. Melbourne's population surge in 2023, fueled by a significant share of Australia's net overseas migration, dramatically tightened the rental vacancy rates to less than 1%. Now, this figure sharply deviates from the 5-year average of 2.2%, and consequently, because there isn't enough rental properties to meet this demand, rent prices escalated by about 10.7%. This is a clear signal of a mismatch between the market's supply and the genuine need for housing. So housing market supply in one hand is good, with more supply than what's needed, so prices have pushed down in those markets. But on the other hand, there's not enough rental supply for those needing to rent a property, so vacancy rates have plummeted and rents have skyrocketed. Now, the divergence between this example of purchasing and rental market dynamics underscores a crucial distinction. While changes in policy settings influence purchase values by affecting the sentiment of the investor, rent values are driven by the steadfast need for accommodation. So in conclusion, while falling property purchase values might hint at an oversupply, the escalating rental costs reflect an undiminished demand for housing. Now, this scenario poses pivotal questions about the real nature of supply in the context of market demands versus housing need. Now, I believe the confusion often arises from supply and demand headlines we see in the media, which is obscuring the basic human requirement for shelter, a need not met for everyone due to affordability issues, such as rents skyrocketing, which is a distinct affordability issue again from the act of actually affording to purchase a property. Even as property prices may decline in the buying market, our housing system remains deficient in providing enough homes, and we have a whole video on this topic, and the link is in the description. This is a fact also underscored by the 2022 Productivity Commission's report, which revealed that over 100,000 individuals were turned away from specialist homelessness services in the fiscal year 2020 to 2021. Therefore, falling prices in the private sector due to oversupply does not address or even serve as an indicator for the fundamental shortfall in housing supply from a social standpoint. And this is just another reason why we can't look at data or indicators in isolation. Understanding this issue may revolve around the complexities in the real estate market rather than in relation to the broader housing ecosystem. Real estate, especially dwellings, is distinctive because it straddles both the private market and serves as a crucial social necessity. Everyone needs a place to live. Despite fluctuations in market readiness or sentiment influenced by economic factors, interest rates, income levels, and consumer attitudes, the core issue remains that a significant shortfall of housing exists in Australia. This scarcity is more evident in rental market statistics, where rent prices in Melbourne have surged by nearly 11% in the past year, highlighting a mismatch with the surplus of housing stock in the buying market, where 81,000 properties were sold but 90,000 were listed, which on paper would show an oversupply. Now, this situation underscores the need to differentiate between the market for buying properties and the fundamental need for housing Australians. Supply and demand in real estate must be understood through both a market lens and a social perspective, and it should be delivered in that same vein rather than all being packaged up together. The implications of these trends extend beyond the housing market because it touches the lives of so many millions of Australians. As everyday Aussies grapple with these complexities, the distinction between market supply and the actual need for homes becomes a crucial consideration in understanding the current and future state of Australia's property market. Now, as I mentioned, check out our video here on Australia's housing shortfall, where we go into much deeper dive into the data that supports Australia's housing undersupply, both right now and into the future. Until next time, happy property navigating.